Hey guys, we're going to go ahead and get started. How's everybody doing today? Cool. Thank you all for coming. I know that it's getting towards Thanksgiving. I hope everybody has awesome plans for the holidays. Want to introduce everybody to Shelby Sievers. We work together at Bramlett. She's going to facilitate today, not necessarily moderate, but we are going to try to make this as conversational as possible. We had one of these events a couple of months ago, and really the input from the audience is it's my favorite part, right? So we can just kind of talk, see how things are going. But I'm excited to talk about what I've seen in the market in 2024. I'm excited to hear from Max, what he saw in the market, in the mortgage market in 24. And then we're going to definitely add the disclaimer that neither one of us are very good at predicting the future, but we're going to try, and I'll hedge it as hard as I possibly can. And then we're going to discuss kind of strategy and whatnot. And I'm a broken record whenever it comes to strategy, but we'll chat about that. And throughout the whole process, like if people have ideas, questions, just raise your hand. Shelby's going to walk the room, and we just want to have a great day. So thanks y'all for coming. And Max, thank you for being here.
Yeah, thanks everybody for being here. Excited to do this.
Cool. Everybody can hear okay? I mean, I think the volume sounds good. Cool. So to get started, Max, do you want to start with the mortgage market, or do you want me to start with the real estate market? They're pretty intertwined.
Yeah,
so.
I mean, we can start with. I'll start with the mortgage market. So, it's been definitely a better year for loan officers for the most part than 2023. I think we can all agree that when rates go from 3 to 8%, it's not good. This year didn't go exactly the way everybody thought. Everybody was. I remember talking to people this time last year. We've got all these sellers waiting. We're gonna put our inventory on in the spring when rates are going to be 5.5%, and everything's going to be hunky dory. And that didn't happen. Although rates have been better this year, and I think that's been a big part of the messaging. It's always been very easy for people to just get caught up in how crappy things are compared to whatever they're compared to, right? I mean, you look at it now, rates hit a bottom of about 611 in September, right before the Fed cut the interest rate, and they've pretty much gone up ever since.
Can I ask a question? And we've talked about it, but I mean, everyone here, we know that mortgage rates are not directly tied to the Fed, but they're obviously very closely influenced by the Fed. Walk me through, help me understand. Before they start cutting rates, it drops to 611. Yeah. Then we have a half a point. So effectively two rate drops by the Fed, and then they bounce back after that. Not even before the election. What happened there? How do we drop so severely and then bounce back after the good news hits?
Well, it's the market's always forward-looking and reacting to what they think is going to happen.
But that's what they thought. They thought it was going to be 2 rate drops, and it did. So
first of all, in September, the overall sentiment was they were going to cut it a quarter, not 50. 50 definitely seemed to be a little too much, and really the result was fears of inflation coming back.
Because they overreacted and
I mean they cut too much, and then what happens, right? Like mortgage rates follow inflation. Like at the end of the day, if inflation's going up, mortgage rates are going up. Right now, the market's always the bond market, the stock market, everything's always reacting to what the Fed says they're going to do. And then kind of depending on what they do, if they get out of line from what the expectations are, that can be a bad thing. Sometimes it can be a good thing. But, I think the bigger issue was, I mean, you look at the fact that we had another quarter rate cut last week.
It didn't even hit the news.
Nobody's even talking about it. Right. But you have CPI has been getting worse since July. Basically, the inflation numbers have been coming up since July, which is bad for mortgage rates.
But not to get into too much into the weeds, but inflation numbers were incredibly low. And then as soon as the Fed indicates they're going to start easing, isn't it expected that inflation numbers would bump back just a little bit? They lag by at least 6 months, maybe even 12 months.
Yeah, sure, maybe. But, I mean, the market's going to do what the market's going to do. I mean, I don't have this is exactly why it happened. I mean, it just kind of is what it is. But to the point that the Fed doesn't control mortgage rates, this is 100% true and accurate. And this was a good lesson for everybody. We had how many customers that said, I'm going to wait for the Fed to cut rates before I go buy a house, or I'm going to wait for the Fed to cut rates before I refinance. Oh, wait, now they cut rates. I'm going to wait till the next rate cut. And I can't tell you how many phone calls we got from people after this last Fed cut. Okay, we're ready. Let's go. Well, now your rate's a point worse, and it doesn't. And I think it's a good reminder to everybody to be educating our customers, our buyers, our sellers, that the Fed does not control this policy, and you really need to be taking what the market's giving you and not make a play based on what rates are going to do. I mean, go back to last year, right? How much inventory did we have on the market this spring because everybody knew rates were going to be at 5.5, and that was going to be the best time to sell?
Right. Right. Yeah, we did. If everyone remembers, I mean, anecdotally, we had a very short window of a great market. It was maybe a month, right? I think it was in March. And if you look at the pending units now, you can see that it actually spiked up. And I was happy. I said, oh, great. Like, this is the beginning of the recovery. It was not party time, but it looks like maybe we don't have to wait until survive till 25. Maybe 24 is really what's going to be it. And that was the early influx of buyers that hit the sellers that were there. And then how quickly did it drop? It dropped incredibly, incredibly quickly.
You know, and I think that, again, I think 23 was the bottom. You know, I think most of us have had not worse of a year than 23. I think there's a lot more optimism.
I mean, 24's turned out to be pretty bad, and I'll talk about the numbers in a sec.
Yeah. So anecdotally, well, fine. Good for us. But anecdotally, like as I'm talking to agent, like I know you put out your numbers and all of that, but when I'm talking to agents throughout the city in this market, not everybody's doing better, but I think a fair amount are.
Well, that could be a number of things. I mean, at a high level, the numbers at a high level, the market it underperformed 2023, but sure. You also have thinning of the herd, I guess you could say. So the people that are still in business are taking more market share of that bit smaller pie. That's probably the dynamic that I think might happen.
Yeah, so I agree with that.
Absolutely. I'll dig into numbers. So we've always looked at the broader market. We've always looked at whenever, like the way that I started running numbers was literally going to Matrix and just putting in the 5-county area and just running numbers. And we use a different tool now, but it's still the same. It's still the same methodology. Well, the tool we use now is a little more sophisticated. Shout out to Aaron at Agent Intel, and it allows you to save markets. And I had a market saved for 5-county resale. And I accidentally ran numbers for 5-county resale a month ago. And I was like, oh my God, things cratered. What happened? Well, it was because I was looking at 5-county resale. And my sort of discovery is that the new construction market has taken a big chunk of what we're doing, right? Makes sense. These guys are not going out of business like they were in 08. They want to make money. They're going to operate at thinner margins because they want to make money, any money, better than none. And as a result, the resale market has taken a beating. For us, everyone in this room, what does that mean? Well, with some very, very, very small edge cases, it means that you get at best 50% of the sales on new construction, and we all know that's not even the case, right? Nobody here is like, you're not listing stuff for D.R. Horton, right? And on the buy side, which is where you have the opportunity to participate in, you're taking a fraction of it as well. I don't know what the numbers are on that, but it means that whenever you look at the entire market that includes resale, it looks rosier than it really is for agents. And for your clients, it looks rosier as well. Your clients are competing with these new home builders. They're not participating. And the new home builders are willing to cut deeper because, again, they are in business. They're in business to do this. They will sell until they go out of business. So that's my long-winded explanation. Units sold when we're looking only at the resale market, what would you guys guess versus 2021? It's almost half. Yeah, 44% down versus 2021. Closer to the mic? Yes. Okay, I don't like the sound of my voice, though.
Auto-tune.
Can you hum in the background? But was 2021 normal? Of course not. I would argue that beyond the paycheck, I didn't like 2021 very much, right? So we did look at a 10-year average, which I think everybody could say is a normal market, and it looked remarkably like 2019. So just because it's easier to relate, we're going to compare it to 2019 as well. So we're down 44% versus 2021. And who would guess versus 2019 on units sold? 25 lower, yeah. And these are year-to-date numbers through September, right? So the story has been written for 2024. There's nothing that's going to happen short of aliens landing who want to buy houses that will change 2024, right? Days on market, what do you guys think if you had to guess versus 2021? Yeah, it was roughly give or take 15 days in 2021, which anybody who's done this for longer than 7 or 8 years would tell you that's like you'll never see that again. Versus 2019, much more normal market, 40%. So not as bad, but still it's a longer relationship. And then whenever you think about our experience, whenever I think back to the last different market we had, I'm not thinking about 2019. I'm thinking about 2021, right? But that puts it in perspective. Yes, the relationships are longer. Yes, there are way fewer solds, but it's not dramatic in terms of days on market. We just started monitoring this, and as a glass half full kind of guy, or I pretend to be, we talk to clients about success rate. But in here, when we're business planning, let's talk about failure rate. So what failure rate means, it's the number of properties that were listed in a given time, and then the number that withdrew or expired. Now they can relist or whatnot, but that listing was a failure if they listed and they didn't sell. What would you guys guess is the average, like the 10-year average? It's the same as 2019, give or take. How many properties, if you listed 10 properties, how many of them?
In our world, it's definitely, you feel more sane, and it's easier, I think, to do 850 units than 650 units. Just because you're always going and all of that. And, there's a lot of, y'all talk about failure rates with listings or buyers, and, loan officers, mortgage companies, we have that same problem, only ours is a little bit exacerbated because you don't see the price wars and the commission cuts and all of that from the agent side that you do with loan officers. Loan officers, a lot of times you'll see it, right? It just becomes a race to the bottom. Who's going to lose the most money or who's going to make the least amount of money just to get a deal done, which isn't necessarily something that you'll have to deal with to the same degree. So we definitely feel y'all's struggle on our end too.
From 2.5 from 2021 on resales. Strategy thing. I mean, everybody, does business slightly differently, right? And if I'm comping for a seller, I'm not going to look at 2021. I'm going to look at hopefully 6 months of comps and maybe 12 months of comps. And then, not to dig into pricing for sellers too much, but, seasonality and then the market conditions for their specific neighborhood are going to come into play for me a whole lot more than, any sort of price trend up or down. What I would look really hard at is look at the failure rate. And I mean, call it success rate. If you tell them, look, if 67% of sellers are succeeding in your neighborhood or in your zip code, that tells me all I need to know with regards to what side of the range where I need to price it, right? I personally believe that it's impossible, like literally impossible. Like AI models will not be able to accurately predict what a home will sell for because the market's different every weekend, every submarket, every home. So I've always given sellers a range. And whenever you have a 35% failure rate, I'm going to tell the seller you probably want to be towards the bottom of that range if you want to sell it this year. If you don't, if the pricing is reasonable and you're willing to risk not selling this year, fine. I'm in this for the long haul, but just understand that that's your decision, right?
So do you just feel like the prices in general, when you see all these price drops, especially new construction like 78704, that they've just gone up so high?
Well, I think you're looking at a different time period. I mean, I think if you look at it versus 2021 versus look at it, when you're talking about the 2024 market, at most you're looking at what happened from Jan 1 to today. And then you go backwards to 2021, you'd have to do a comparison. I think that in 78704 for new construction, what you're seeing is a dynamic of a lot of overbuilding, a lot of irrational exuberance, and now there's a bunch of inventory down there. So that's a sub-market that's going to perform differently than the broader market for a number of reasons.
Rational exuberance. That was good.
You like that word? It's a big one. It's my word for yesterday. Any other questions about I love talking about this stuff.
Back to you.
Market behaves very, very differently than the rest of it. Way you can kind of, I know you do a lot of deep analysis, which is fabulous, but is there a way we can kind of see how downtown is doing?
Yeah.
Just at 78701.
Yeah, I mean, for submarket analysis, you want to dig into a tool that'll let you do that. I don't know off the top of my head. I have been intentionally ignorant of the downtown market for a long time because it's a lot to bite off. And if I this isn't a great business strategy for a lot of people, but I would just, send them to another agent if they wanted to sell downtown because I'm not the guy, right? It does require a lot of analysis. Max knows more about the downtown market right now than I do.
It's not great.
Downtown markets swing a lot. They can input a whole lot of inventory, very quickly in one skyscraper, and we generally see more than one skyscraper built at a time. So, yeah.
A lot of those now, you're seeing all these projects that have come online in the last year. Gosh, I can't remember a time before where new condos came online and they weren't 100% sold and stayed that way through closing. And now it's, these things have been online 6-8 months, some a little bit more. There's 50% left in these buildings to be sold. In some cases, more than that. So, from our side, we definitely help strategize with the developers. What are we seeing? Are we looking at doing forward commitments where, you get these emails from a DR Horton, 499 for 30-year fixed and that kind of stuff. It's called forward commitments, and it's a longer story for another time. It's something that we do, though, where you can basically buy a block of loans, and the builder can pay outside of seller concessions to get that lower rate. So you talk about that, price reductions, seller incentives, seller paid closing costs, that kind of thing, to try to help strategize with them. But I haven't ever seen the condo market like this.
Oh, I contradict, but yeah, in 08,
in recent time, I would say since
100%.
since 2013, 2014.
But it was a similar, that's, to use the word again, irrational exuberance. I don't know how irrational it was, but everybody gets very excited about downtown. It's an exciting place. It's easy to be excited about downtown. And so people pile on and they buy more and things work out. And then all of a sudden the market shifts and they don't anymore. And you don't generally see big wild swings in the real estate market. It requires a lot of movement for that to happen. But downtown, it does. It is more prone to that than other areas, I think.
Well, I think one of the things that you got me on it, right? Like Indeed job postings, right? And I've heard people refer to us as Silicon Hills, right? We're a very tech-driven city, and when tech jobs left, we saw this downturn, and I think a lot of that is in the downtown area. You've got a lot of Google and Facebook and all of that other stuff around there. I think that's really attracting the people to be downtown, and I think that's a big reason why you're seeing what you're seeing now.
Totally agree. It's a good segue. We can talk about predictions and say what we think will happen. The reason I say that is because the Indeed job postings are they're one of the key leading indicators you can pay attention to see what's going to happen in 3-6 months from now. Spoiler alert, those aren't good, but it's not the only variable that you want to pay attention to. I could strongly argue that mortgage rates are the key variable for 2025 that we want to pay attention to. So take it away, Max. What's going to happen with mortgage rates next year?
3.25. I'm kidding. So I still very much believe that we're at the top of where rates are. If you look more towards the rest of this year, I think that we're going to see rates kind of bounce between. Let me preface this with, whenever I talk about what rates are, I'm always using Mortgage News Daily. I think that's the best website to go to look and track. Freddie Mac puts out numbers. Other places put out numbers, but they're usually a week old and they're not very consistent with how they do their data. So Mortgage News Daily, it looks at nationwide, 780 credit score, 25% down, owner occupied with a point, and that's a measure. For the rest of this year, we are going to see rates probably bounce between 6.7 and 7.2 on that. I think if you follow, I follow the 10-year Treasury really, really closely. I've been tracking the latest level I've been tracking is specifically 4.482, and it has been holding that line with CPI numbers coming in today at expectations.
Did that already happen today?
Yeah, it was at 7:30, and everything across the board was exactly as it was predicted. So flat on the year, headline up a point. I haven't dug into it too much, but some of the big headlines were shelter was actually the biggest cause. If you strip out shelter, we're at the Fed's 2% target. So that's a good sign, and the mortgage bond market has reacted positively to that. Going into next year, I think a 6 handle for the first quarter is very reasonable. Actually, printed this out. MBA and MBA always have a little bit of the different forecast, but Fannie Mae predicts the average rate for 2025 is going to be 5.7.
Send the statistical talking points to you guys in case you'd like to have them. I know it's nice to have that stuff in your back pocket, and I'm looking at Max's right now and I want to see it. So.
Yeah. And then MBA's forecast for mortgage rates to end 2025 at an average of 5.9. So call it what you will. What I will say about both of them over the last several years, since I've been paying attention, mostly since I started a mortgage company, they're usually wrong. When they think they're like, when they said rates were going up, they exceeded expectations. A few times they've said rates are going down. They've gotten better. So take that anecdotally for what it's worth. I think probably by summertime, it's reasonable to expect we could see average rates around that 5.5 range. Unemployment's expected to be, I just looked at it here, 4.7 by the end of 2025.
Is that up or, where are we right now? Is that up?
4.1.
4.1. So we're going to see it go up, which what you've always told me that I always remember is that bad news is good news for the mortgage market. So if we see the unemployment rate go up, we'll see mortgage market react.
That's right. Because again, the mortgage rates follow inflation. And that's what the Fed's wanted. Like the Fed has wanted, the one thing that the Fed has not got, and that's probably because of how the data is put out there, although I don't buy a lot of it, that there hasn't been a labor recession, right? We've had this rolling recession going on, but the labor force hasn't broken. And that's been the biggest issue that the Fed had.
Talk about that for a second, because or more than a second, does it feel like job market's great in Austin? I feels to me like it's not good. It feels to me like it's pretty bad, right? In the past, what has helped Austin along a lot. So we're very lucky here in that we have government, we have a lot of universities. You say healthcare, but any big city has healthcare. What's helped us in the past is the tech market. We have tons and tons of major tech employers that are here, and tech has been frozen for 2 years. Yeah. How many people have worked a lot of relocations in their career? Raise your hand. Okay. How many relocations are you working at present in the past year or two? Right. They've all been dried up. And then how many people, so it goes both ways, right? We have sort of this migration between typically Northern California and Austin. And again, goes both ways. We always hear about it here, but it goes the other way. How many sellers are you representing that are moving back to San Jose area? How many sellers are you representing that got a new job in Nashville or anything like that? They're gone, right? So for Austin, we're used to, what's the number? It's like 150 people a day moving in.
Something like that.
Call it 150 people a day moving in. We won't know for a while because that takes a bit for those numbers to come in. But my gut is that we will have just net neutral migration, which is normal for a lot of cities, but not Austin. Austin is, I've lived here since 2002. City's doubled in size in that amount of time. It doubled in size from 20 years before that. It's supposed to double in size again 20 years after today. And right now we just have, it's just flatline. So the job market, the tech market, verifiably, is it okay? Verifiably is doing poorly. And if you want to monitor it, look at Indeed. LinkedIn has some good market reports that you can also look at. It will, they've tracked along the entire time.
So I've always thought it's interesting, just as we talk about this, and I feel like a lot of times I think out of both sides of my mouth, right? We want unemployment for mortgage rates,
but
we need higher unemployment.
Except for tech, yeah.
We need higher unemployment, but we need better employment here to get people moving back, and it's always this what's going to happen kind of situation. So, right.
You're not sure what to cheer for.
Right. So it's I generally can find myself that I can make an argument like you that things can go one of two ways, and I can strongly argue for both sides of that. I think that.
How did you get to the 4.7? Where data point was that? Where did you pull that from? You said unemployment would be 4.7.
That's MBA's forecast.
Gotcha. Okay, yeah. I miss it. I was just, which is interesting. So I'd be curious. What do you think it's going to be? I know you said you could go either way, but you got an administration that's going to loosen, right? On businesses, you have several dynamics going on to be curious to think that unemployment's going to go up, other than maybe you have pullback from government jobs?
Well, I think you're going to have big pullback from government jobs. And when you look at the unemployment rate as they report it now, the government jobs being added is essentially why the unemployment rate's not 5, 6, or 8%. I mean, I don't believe that the unemployment rate's 4% right now. I think the way that the government reports the unemployment numbers, the fact that if you've been out of a job for however long, I don't know off the top of my head, I think if it's 90 days, then you're no longer counted in that figure. If you're not claiming unemployment, then you're no longer counted in that figure. If you lost your job and now you have 2 part-time jobs, you're not counted in that figure. So I think it's very difficult. I don't think you get to do it. I don't think that we can say that unemployment's going to be lower with the new administration if they do what they say they're going to do. But that it's
well, there's a whole separate discussion over how much control any presidential administration has over the economy to begin with. What I've observed over the years, and I think a lot of economists would agree, is that economic cycles play a lot bigger part in this than any presidential administration. And so where are we right now? Well, we're in a contraction. We have been for a while. And if you want to play it out, does it make sense that the tech employers are cutting? Why did Tesla shed 10% of their workforce whenever they're growing, leaps and bounds? And the reason for that is that these guys have to contract at some point, otherwise they end up wildly inefficient. And I think they know that. And so whenever we typically have these companies typically have the cover of some news event to trim the fat. Okay, something happened, we have to lay off. You look at it now, I think any reasonable person would say we're moving into a recovery. We're not sure how quickly, we're not sure how strong it will be, but we are in sort of the bottom of this downturn. And they're going, oh wow, we got really fat in 2021, because they did. I mean, to use the rational exuberance term again, think about the hiring. Facebook had 12% of their workforce that were doing nothing, and they let them off I think they laid them off in 2022, something like that. Yeah. So it was because, and that goes back to, that's not a presidential administration that caused that at all. That was because of monetary policy is what caused that. That's because money was really, really cheap. And so they were hiring, and that's what caused work from home. And, unfortunately, they're discovering that the work from home stuff, it's not as efficient. It's somewhere in the middle. So now they're trying to correct. And that's why you guys heard the term RTO, taking advantage of. They're saying it's time to correct from the irrational exuberance of the pandemic job market, the pandemic economy. That's what I think will happen. Now, in terms of the job market in 2025, I don't know. I know that loosening monetary policy causes people to reinvest in their businesses, which a big portion of that is hiring. But what's the lag? And that's something I guess I should probably, I used to say Google, Perplexity, figure out what the lag is. Whenever we see loosening monetary policy actually take hold, whenever we're on the 4th or 5th rate drop from the Fed, when will that cause the tech employers to start hiring? And if anybody figures that out, please tell me. Actually, only me, and then I'll. Yeah, it's a tough one. It's really tough, but I think it is.
That's what the Fed did, right? The Fed raised rates at a rate never seen in 40 years or more, right? To get money out of the reduce M2 supply, get money out of the system, right? Some of the problems that you've seen is because the stock market's still gone nuts. So even though people aren't making as much money, or they're spending a lot more money because everything is just so much more expensive, they feel rich because they look at their 401k or they look at their portfolio, and that's done, especially this year. I mean, it's done extremely well. I mean, the Fed's going to continue to cut. I'd like to believe that the Fed cutting creates more revenue to create more jobs outside of government jobs, to get people back, to move to Austin, to buy houses and refinance and take out their mortgages and all of that stuff.
It's interesting because everybody always wants to, like, what do the numbers say? What do the numbers say? Well, typically anecdotes will lead any sort of numbers. So I have a friend who he's an office guy. He's in commercial real estate, and that's all he does is he leases and sells office space. I'm always asking him how's business. I mean, I care about him, but I also know that his business is going to return for him before it does for us. Before you start staffing up, Well, what's interesting is we're in such a bad office environment right now that we have all of these major employers with space on the sublease market, so they want rid of it. As soon as that starts going away, okay, great. That's like an early indicator that they're going to start filling these offices. Then you'll hear, okay, cool. Now they're taking more space. That's what you want to hear. You know, if you have friends that manage STRs, an agent in our office has a really great business doing midterm rentals, 30 day to 90 days. And I always want to know from Julie, like, what's it look like? Unfortunately, it doesn't look very good, but she will know ahead of most people because she will see people that are moving here for 30 90 days before they end up renting a longer term place or buy or whatnot. So keep your ear to the ground. If you want to specifically keep your ear to the ground, Apple is always in the best cash position of any of these companies. They have a huge presence here. Whenever they start hiring again, they will probably be the first company to start hiring again. Facebook loves spending money. Whenever Meta starts hiring again, they will probably be next. So listen to those things. Then you can go look at Indeed. Indeed will be right behind. They'll start advertising after they've started filling these positions, the easier way. So jobs will lead it. Mortgages, I think mortgages, in my opinion, mortgage rate is what's going to help us recover in 2025. That's the near term leading indicator for a better market. But jobs are really what we need.
That's the meat and potatoes of it, right? Like mortgage rates are great for headline news. I mean, again, when the Fed cut the rate, everybody came out of the woodwork. I heard mortgage rates got better. I heard the Fed cut the rate, yada yada yada, right? Like the news with all of that with all of those things happening, it can be your friend. And I think it's important when the news is giving you friendly headlines that you take advantage of that. One of the things that we talked about, kind of same thing, but moving on, is the rate lock-in effect.
So let's talk about that.
And I've been a big proponent of that's not real in the long term. There's been for the last year or two weren't making a move. I can't give up my 2.5% rate. I can't give up my 3% rate. But now that's changing. Life events are going to happen regardless of what the economy is doing. Right? You're going to get married. You're going to have children. They're going to move away. You're going to get divorced. Whatever it may be, you're Elon Musk and you buy an entire compound for all of your families to live in. Life events happen, right? And you're already seeing that now. Like we've seen I'd say a fair amount of folks this year doing cash out refinances. They don't want to move, but their house is too small, and they're giving up a 3.5% or 4% rate, and they're going to a 6.5% or a 6 3/4 or a 7% rate to pull out money to add on to their house or to redo their house. And some of that on the mortgage side too is, I think we have a duty. We're not just here to give somebody a mortgage, but I think we have a real duty to be debt managers for folks and looking at, do you pull out money to pay off debt? Is that the right move? If you're pulling out this money to add on to your house, is there other money to pull out to pay off other debts so you can get your entire monthly nut down? Do you not take as much money out? And even from the mortgage side of it too, I have a lot of conversations with folks that want to put 20% down because they don't want mortgage insurance. But then we can sit there and look and say, well, hold on. Maybe if you put 10% down, you have mortgage insurance, monthly or single pay premium, which I'm a big advocate of. But then you take that other 10% and you pay off some of this debt that you have. Your actual overall monthly expenditures are better. And I think it's really incumbent upon us as loan officers to come at it from that perspective. But again, from the lock-in perspective, you're seeing a lot of people like finally like, I can't take it anymore.
Yeah, I mean lock-in effect, mortgage lock-in, that sounds really scary, and it's a great headline for clickbait, basically. If I were writing headlines, I would probably use that term. A much better term is pent-up demand, right? So if you decided, the picture I talked about at our office meeting yesterday, you got a 1,200 square foot house, you're somewhat newlywed, and you had a baby 2 years ago, and you decided that your rate's too good and you're not going to move from the 1,200 square foot house. Well, did your baby get smaller between 2 years ago and today? No, you probably had another one, and your house, and your house certainly.
And that's not a lot of space to not step on Legos.
I know, it hurts. and so this is just one story that makes a ton of sense, right? So you can have we've all done this for plenty of time, and we all know that it's usually the husband who's like digging heels in saying our rate is too good. as, a partner that is the voice of reason saying, I don't care how good our rate is, this house is 1,200 square feet and we want to move to a new house. And that's why I think that with all this bad news that we're talking about, it's honestly not, because this is the worst resale market that we've seen since the great financial crisis. By the numbers, I could show you guys why. I could show you by the numbers, if I want to wiggle the numbers, that it's actually worse than the great financial crisis. But that's in the rear view. So all intents and purposes, next year is going to be a little bit better, and we will see outsized results from like a half a point rate drop. Somebody with a 3-year-old kid and another kid on the way, or a 1-year-old kid, is going to feel like 6.5% is a lot better this next year than they felt about it. They felt about it last year. So rate lock, sure. Pent-up demand is the way that I like to look at it. And I strongly believe that pent-up demand is what's going to help us have a better year in 2025 than we had in 24 or in 23. And we don't have to see mortgage rates get into the 5s in order for it to happen.
Yeah, I agree with that.
Max and Eric, we have a question in the chat actually about commercial rates.
I don't know, and I don't care. Sorry. I tend to focus on residential. Commercial rates are I'm not sure what they are. They're generally
tied to prime.
To prime.
So like the good thing for commercial, I'm not a commercial lender, but they're generally tied to prime +1, prime -1, whatever it is. So the good thing about that for folks is, as the Fed cuts rates, you'll see those rates come down on the existing loans that people have.
On that subject, though, I know you had a question 1 second, but I think it's almost kind of it feels like we're getting to crisis averted with what looked like a very high likelihood of a commercial banking crisis that looks like it didn't come to fruition. And if rates continue to come down, wow, we really dodged a bullet on that one. Not that it would directly affect the residential market, but we would certainly see some effects from it. And there'd be a lot of really bad news if that happened.
Thank you. You had a question, right? All right, I'll bring you the mic.
On the rate lock, people with low rates. So
called pent-up demand.
Pent-up demand. So you have clients like you're talking about with little kids trying to go in and make offers now, but sellers who are on the market, they're 300 days, just happily sitting on their 2.5%, not willing to accept a lower offer. It's frustrating for your clients, right? Because they're like, this house has been on the market for a year and we went in and made an offer for 50 grand lower, and
Do you mind
we're trying to make a move here. So.
Eric's going to tell you that's just an unreasonable seller.
Right. But there's a lot of those. So,
well, you can quantify it. That's so when we talked about, so I love success rate, and I'm bummed that I just figured, or somebody else showed it to me and I was like, wow, that's good. Success rate is very obvious whenever you're talking to sellers. This is your likelihood of success. It also is a great metric to show buyers. Yeah. And the reason you do is you can call it a reasonableness rate, right? The 35% of sellers that are going to fail are choosing to. They're choosing to stay in their home. They're not being foreclosed on. They're just not selling. And so you can say, look, 35% of sellers right now would prefer to just go off the market than sell at a lower price. So what does that mean for you? Well, the good news is that there's a lot of options out there, and I understand that real estate's an emotional purchase, but you might be faced with a decision of the house that's perfect for you with a seller behind it who's not super reasonable. And you have to decide if you're willing to pay more than what the market says it's worth in order to get the house for you. Yeah. That's a personal decision. I used to think the other way. I learned the hard way. I talked people out of houses for years in my career when I was a very low producing agent. Right now, you shouldn't do this, because I looked at it as just a financial decision. Then I had one client that I showed him the comps, and they needed to pay $50,000 more than a house that comped out for $400,000, and they gladly did it. And so I did my job. I showed them what the comps were. Anyway, questions on? Do you want to dig into some of the industry topics that have?
Go for it. Yeah.
Do you guys want to have a very short discussion over?
I was going to say, we did the last time we did this was we talked about the NAR settlement, and it's 3 months in the window. Yeah. And I know you have some stats. I'm sure people would like to.
Yeah. Statistics, and it sounds like these are made up, and they're not. We have an internal tool where everybody submits their contracts or whatnot, and there's thousands of them in there. And the contracts on the buyer side only that were submitted post August 13, the average commission is 3%. The contracts on the buyer side only pre August 13, the average commission is 2.94%. So we've got 100 something contracts, wish we had more, since August 13, and like 3,000 pre-August 13. And so what that tells me is that the NAR settlement is going to cause commissions to go up considerably. I'm joking. What it means what it means is that the NAR settlement didn't do a whole lot, right? It caused a lot of worry, and I could argue that it's probably better for the consumer. I love transparency, and so talking with buyers up front about what you're going to earn is something that hopefully you develop that skill. We'll see a lot of heads nodding, and so I think that's ultimately a good thing. I think when it all shakes out, you'll probably see an average that comes down just a little bit. Like if you talk to me in 5 years, whenever we see an up and a down cycle of a market, it's probably a little bit lower just because we're talking about it. But was the NAR settlement a seismic shift in the industry? No, it wasn't. Were there things that we have to work through? Yes, there are. It's totally normal if you're still struggling with this, but there are proven ways to show your value. You shouldn't have to come down on commission. And, I don't know how many seismic shifts that turned out to not be I've seen since I've done this. And this was another one. I would love a counterpoint. Anecdotes are important. Whenever you're talking about your paycheck, it doesn't feel very good whenever somebody like bullies you into taking less or forces you to make a tough decision about what you're going to earn. The emotion behind that stinks. But does that mean that we are going to earn a different amount over the next year, 2, 3 years? Right now, it doesn't look like it. It doesn't look like it at all. Yeah. The other concern was it's going to cause financing problems because of how we're structuring deals now. I'll let you speak to that. Have you seen any deals?
I think we had a question, actually. Do you have a question still related to that?
In my opinion, if we were in 2021 market, I can guarantee that the sellers would not be willing to pay 3% to the buyer's agent.
I would argue that very strong statements like that are usually not right. Usually it's somewhere in the middle. I could also point out that there were many sellers that didn't pay the buyer side commission in 2021. I can strongly point out that there have always been discount buyer side brokers out there. I can also point out that many sellers didn't pay the title policy in 2021. And the last thing that I will point out is hopefully a security blanket is that we will likely never see a 2021 market in our careers again. That took a pandemic and it took 2% interest rates to get that. And if we have another pandemic, it'll be the second one and people won't behave exactly the same. So I do agree with you that in a seller's market, sellers have more leverage. Sellers get more net for their property in a seller's market. But I know for a fact that sellers care about their net, what they take home, and buyers care about their cash outlay at closing. And those two dynamics mean that we will typically have all commissions rolled in to the loan, which is the net result of the seller paying the buy and the sell side. That transaction cost, which is what it is, it's what a title policy is as well, is effectively financed whenever the seller, that's how we make it happen, is the seller pays it and it's effectively financed. And it's a lot easier to pay an extra, whatever it is, $100 a month than it is to come up with $25,000 at closing. I probably just got the numbers wrong on that. Great. It's a great observation.
It's fine. But you look, I mean, we really haven't seen much. I mean, like I said, there's been a deal or two where buyers had to pay, 1% or 0.25% or whatever it is. I actually came across, I spoke to an agent yesterday on a deal that I'm not a part of. He's the listing agent, and the buyer's agent didn't submit any forms for their compensation, and he was asking my opinion on his fiduciary to the seller. I don't know what he's going to decide to do, but that's the only instance I've heard of that, and I'm sure there's others. But for the most part, I was saying before it happened that it's going to be kind of a big nothing.
I think I used the word nothing burger.
Nothing burger.
And then
yeah.
Emily corrected me.
Yeah.
Said it's a big deal, and she was right.
I mean, but look, I mean, is it? Here we are 3 months later. It's like
it's been a big part of the conversation, and it's been very, very concerning. And for whatever reason, and I'm going to throw a quote out here in a little bit from a podcast I listened to yesterday. There's always something. There's always a topic that is a big part of the conversation that's either very, very exciting or very, very concerning. I feel like we're at the tail end of it now. What about AI? What about AI taking our jobs? What about AI revolutionizing the industry and telling us exactly who's going to sell this year? Here's do a deal because AI told them that the seller is going to sell this year, and you didn't know until then, and you called them and it closed. Yeah, it was all over the news 8-9 months ago. Now, clear cooperation is what's in the news right now. It's what everybody's talking about. How many people have been affected by clear cooperation in the last 3 years? Received a fine for it? Have you changed your business significantly in any way? Helped a buyer buy a house faster or seller sell a house faster? Any impact? It's in the news, right? And that's what everybody's talking about right now. It's because things are exciting to discuss. Why are we all here? I love talking about this stuff, right? We're going to get hopefully some good business planning out of it that could probably be summarized in a paragraph. But it's exciting to talk about. It's exciting to talk about stuff.
Good.
Mike.
We are very fortunate to be here. But how does you're correct. And my point is only that it doesn't affect us here at all. If it's taking up much of your mind space, that is something that you're choosing to do that's not going to affect your business. And my point is that AI, Shelby, how excited am I about AI?
Eric loves AI.
At the end of the day, it's helped us write property descriptions better in the last year. It's helped us create some better blog posts. I don't think we still
Definitely up my wife's Instagram posting about loan people.
It's done
For sure.
We talk a lot about practical ways to use AI, but we're very realistic about what it will and won't help us with. So
more, not at all. Before, I tried to systemize that too. If anybody wants to have a meetup about AI, no, seriously, the best way to use AI, in my opinion, is to freaking use it. I'll try not to hijack this for too long. It reminds me a lot of the internet in the 90s, whenever you'd get online and you weren't sure which search engine to use. I remember there's one called Web Crawler that I used simply because I thought the icon was cool. And but the important thing was to be online. People that didn't get online and figure out what to do with it, they were way behind. And with AI right now, that's kind of where we are with it. It's a really powerful tool. It does a lot of things really well, does some things really terribly. Don't try to ask it to do math. It'll mess that up pretty bad. But figuring out what it can do, how you can use it is kind of the name of the game. But my point is that the discussion, the conversation around it was another threat to our jobs. There were going to be some more tech guys that were going to come in and upend the industry. And it didn't happen.
couple questions. One, can you remind everyone what podcast you are referring to?
Oh, it's Mike Del Preti. He's a scholar in residence at Boulder, a numbers guy. He keynotes a lot of Inman deals. I'll email it to everybody because this latest one he did, he generally has really good guests on. He's had the CEO of Redfin, people like that, and a lot of really interesting people. But he did an AMA with himself, and so he got to stand on his soapbox. And I happen to agree with probably 99% of what he said because he's really insightful.
Cool. Thank you. And then we have a couple of questions
on it, but I am curious how you think the upcoming presidency will affect our business.
It's either going to be really good or really bad or somewhere in the middle.
Fair.
Yeah, go ahead, Max.
I think it's kind of yet to be seen. If we talk about monetary policy, I'm going to preface this with this is not a statement, and I'm not taking sides in any way, shape, or form. President-elect Trump has said that he wants to make the Fed essentially biased. He wants to control monetary policy. I think if you look at his history, for the most part, he'll probably, good or bad, he'll probably do it.
I don't know, probably. It's a maybe, in my opinion.
Maybe, probably. I think that he's a real estate guy. I think cheaper debt is good for him personally. And, I think that's partially how he governs is what's good for him. Again, right or wrong, but I think that there is a case to be made where the presidency can try to control monetary policy. I don't know if that's good or bad. But I do think that's a possibility.
The way that I'm preparing for it, Trump obviously loves to do things big. I think everybody would agree with that.
It's pronounced huge.
Huge. that is a fair statement that I think doesn't make anybody hate me. All politicians care about the next 4 years. They want to get their party reelected or they want to get elected. He cares about the next 4 years in a huge way. So how is a Trump presidency different than a Democratic presidency? Well, probably a bit more focused on the next 4 years and less focused on the long-term implications. So if that is true, then you say, great. If we have really strong boob times because there's been more influence on the Fed, to lower rates, which we would then pay for longer term, then that's what we have, and make as much money as you can and save some of it or save more than you would normally. And if I'm wrong, I just helped everybody save some money. So like, what's the downside? You know what I mean? I think you always want to make hay when you can, and then you probably want to sock some of it away. I am probably dialing that up a little bit more just based on what happened than I would have otherwise.
But I think
still provide some value.
I think at the end of the day, one thing that we talk about a lot is real estate's just hyper local, and when it's all said and done, whoever's in office, whatever party, whatever person, this is all about, for us, the Austin market, and that's really what to focus on. And I think that you need to have your plan for 2025, your business plan, basically your A, B, and C plan, right?
I'll actually, because you guys asked about the Del Preti podcast that I like so much, and I actually yanked a quote from him. The other day, what do you think the market's going to do in 2025? I said, A, I have no idea. A, I have no idea. B, anybody who has an idea is lying. I'm not lying, guys. And C, it's the wrong question to ask. The question to ask is, no matter what the market conditions are, what can I do to be successful in that space? So we can predict, and it does give you a leg up to accurately, within reason, predict what will happen next year. Forecast, things hopefully will be a little bit better. Not going to be rocket fuel. That's kind of what we're looking at. But to plan for success in any market conditions, that's what we all need to do. That's the right question.
And I think that's your A, B, and C plan. The market gets worse. The market stays the same. The market gets better. And what systems are you going to put in place? What people are you going to put in place? For us, we're taking resumes now. We're looking at processors, operation folks. And once we hit certain metrics and we see certain things happen, we'll pull the trigger. But we're getting ready for it now. Now, if these certain triggers and metrics don't hit, then we won't. But at least we can be prepared and ready in the event it does. I believe that 2025 will be a better year for loan officers and real estate agents than 2024. I believe the worst is absolutely behind us. We thought this year was going to be better than it was. I'm not saying that next year is going to be phenomenal, but I do think it's going to be better. And I think when you look at it, obviously I look at it from an originator perspective. 2000s, people would refinance. You had customers refinance every year, 2 or 3 years in a row. It was kind of this slow crawl down on rates. And I think that's a more realistic scenario of what we'll see this time around. I don't think that we're going to see rates drop a point in a month or 2 points. I don't believe that we're going to see a 4 handle anytime in 2025. Maybe not even 26, but I think that it'll be better, and I think we'll do more business. And so, we're making plans as such, but I also have my contingency plans in case shit hits the fan and it's not good again. So
I would say whenever we're trying to forecast the market, there are 2 things that we care about. How do we guide our clients, and how do we business plan? And from a buyer perspective, I've given the same advice for 20 years. That is, if you're sure you're going to be in the house, 100% sure you're going to be in the house for 3 years, and highly likely you're going to be in the house for 5, and it's the right time to buy for you, you should buy. It's really tough to find any 5-year period in Austin where you didn't at least break even. I think probably make money. I would challenge anybody to find a 5-year period where you didn't break even, and maybe you can, but probably not. The average in the United States, a homeowner stays in their home for 12 years. That really surprised me when I learned that. I thought it was shorter than that. The average in Austin is 8 years. And that makes a lot of sense because, we're a transient city. People move in and out because of tech. There's no 8-year period that you're going to find that people didn't make money. So Steve Crossland in our office always says that trying to time the market trying to time the market often doesn't work out. And you should probably buy a house when you need to buy a house and sell a house whenever you need to sell a house. Now, you do run into situations with sellers. The sellers who bought in May of 2022 are in a spot. And those are tough conversations. And that's your job, just to have those tough conversations. And there's nothing anybody in this room can do to cause their home to sell for significantly more than anybody else. If you're doing the right things, you're guiding them through that decision. And maybe the right decision is not to sell this year. And you just have to be okay with that.
My next question, for any of us who have listings right now that aren't moving, going into winter, once Thanksgiving hits, it's going to slow down dramatically. It's already slow, but do you have any best tips for strategy? I know it'll depend on the seller and what's going on in their world, but are you more inclined to keep it or take it off and relist in the spring? Anything?
With very, very rare exceptions, we always pull it off the market. And there are a few reasons why it makes sense. One, nobody's buying houses. You want to look like a new listing when you relist. So you pull it off the market for 90 days and it looks like a new listing in the spring. There's a whole other list of reasons why it makes a lot of sense. The only people, in my opinion, that should be on the market are those that really, really need to sell. Or people who love buying scratch offs, because you'll have a way better odds of hitting on a scratch off than you will selling your house in Austin during the holidays.
Rates. I'm just curious, with the run-up of crypto recently, if there's been any indication as to how that could affect monetary policy, interest rates, and.
So, you don't really hear a lot of people talk about that in the mortgage space with regards to rate. Now, I think it's very similar with the stock market in the sense that you're just going to continue to add money. If people sell, you're going to continue to add money supply to the system. What I would say, I'm heavily invested in crypto, and
it's all Doge too.
Good for you.
I've done well. People don't sell, so there's this run up, and everybody's going crazy, and they feel super, super rich, and then it comes down, and it keeps going down, and it keeps going down. And so I don't like the average investor, crypto investor, they don't ever sell. And so I don't just anecdotally, I don't think you're going to see that necessarily all that cash necessarily impact.
You're talking about, it affect the real estate market
or mortgage rates.
Yeah.
I don't see that I don't see that factoring into it.
And I don't know if this is your question behind the question, but a lot of times whenever you hear this, it's like, is the dollar going to lose its status as a world reserve, right? That's kind of the fear. And I don't think that that's highly likely. I don't think it's likely. There's a whole bunch of reasons. It's a topic for another conversation. It's really scary, the same way that the NAR settlement was really scary. But the likelihood that we lose our status as the world reserve currency is pretty low. And if it gets closer, sure, pay attention to it. But it's something that will probably distract you from your business if you're worrying about it, and it's unlikely to occur. That's my position on it.
I was just curious. Talking about monetary policy and the Trump administration wanting to, have an effect on that. If there's been any discussion in the mortgage industry or the financial markets about non-traditional ways to influence, the dollar.
Well,
and interest rates and things.
Not that I've seen, no,
okay.
But I did see something the other day, and it was a headline, and I don't know if it's real or not. I have done zero research on it, but there was a headline that came across that said that the U.S. government wants to buy 1 million Bitcoin over the next 5 years for reserve currency. I could see that happening. I don't know what that does. I don't know, but Bitcoin specific, crypto is here. Bitcoin is it's here. You have ETFs, you have your Ethereum ETF. Solana's probably going to come out with an ETF. Crypto's here, but nobody's really talking about it in that. It's a great question, and I wish I had a better answer for you.
It's the question. It's very interesting to discuss. Something really boring. It's not super interesting to discuss, right? A friend of mine used the term, does it move the needle? Yeah, but does it move the needle, right? And I think it's something that is important to ask yourself all the time. Like, this thing that I'm thinking about, this thing that I'm doing, is it effective? And so, do you mind if we move into like business strategy? Yeah. So strategy for 2025, as I can see it, doesn't really matter who's in the White House. Doesn't really matter if we have a fast recovery, a slow recovery, or if we flatline for next year. The easiest way to impact your business is to focus on what's already worked for you, which will be the basics. And that's not exciting at all. How many people, the majority of your business comes from your SOI? Raise your hand. How many people have your database 100% organized of those people? Raise your hand. Good job. That's phenomenal, right? You have a gifting program, sends out something every month. It's awesome. Are you making phone calls to them every quarter? Yeah. I mean, these are all things, guys, that will move the needle for you. An agent in our office always uses the example because she impresses me so much. She had to slow down, but she was doing 3 in-person meetings a week. Her numbers were through the roof, right? Now, she couldn't keep that up. That's why she had to slow it down. But in-person meetings with your sphere of influence will work. That's going to work. I will channel myself from 2003 and say, whose SOI is comprised entirely of bartenders and people that hang out downtown? My SOI was hot garbage. Didn't matter how hard I worked it was going to not perform for me. I think I sold 1 house to my SOI. Thank you, no doc loans, right? So I had to figure out something else. So if SOI doesn't work for you, you need to look at what's working for you. And if nothing has worked for you, like in your career, then man, like, figure something out that does work. But dial up the basics to 11 and focus on that. And when I'm saying the basics, by the way, you can summarize it all into pipeline building. If you focus your time on pipeline building, that's going to affect your business and your life more than anything else you could possibly do.
No, I mean, I agree. I mean, we talked about it, right? You like to talk about Russell Shaw, your mentor, on what's working and just doing more of that. That's really what we've really tried to focus on a lot this year. And you said something back to basics, and we were talking the other day. I don't think it's back to basics. I think it's continuing on the basics. If you're not back to basics, you're probably not in the industry. And then you come back to, okay, so I said earlier, I think I've spoken with a fair amount of agents who are doing better this year than last, despite the numbers. And it's maybe because so many other people are no longer in the market. And if that's the case, it's likely because they didn't get back to basics. And everybody that made it through 2023 and through this year has already done that. So now it's continue doing that. And how can you improve here and there on the things that are working to make them a little bit better?
The hard part and the perspective you have to have is that because the units sold are down so much, our most recent memory of good times, 2021. Well, what you're doing now, you're going to get half the results you did in 2021. You have to be okay with that. You have to say that's completely normal. I talked to an agent, not our firm. We were talking about potentially partnering, and his pivot whenever his normal, reliable basics worked was he like ditched everything and started trying all this new stuff, and none of it worked. And that was no surprise whatsoever. Stuff that's working in the past, stuff that worked in the past is going to be half as effective now than it was in 2021, but it's going to be like, 40% as effective in 2025. And you just have to be okay with that.
Well, and you can't, again, like you talk a lot about, in my side, we talk about 20 and 21. You talk about 21. Those are black them out, scratch them out. Like they don't count. They really don't. Like the metrics that I look at, I compare 2017, 2018, 2019. What does that look like? We talk about units and volume and all of that, but it's 20 and 21. You like for newer agents and newer loan officers, people that got in the business in 22 and 23, I think to a certain extent have a little bit of an advantage because they're not thinking about how awesome it was. Back then. And there's, you've got to do mental gymnastics to get that out of your head. Like, it was great. It'll never happen again. we all hit the best scratch off lottery we could. But I think you can't even compare to.
It's just hard not to. I mean, unless you've done it for a lot of years, then it's hard not to. Because let's say you started in 2015, right? This is year 10, and half of your career has been this wild swing. So that's 50. This is like what the market is to you. It's like you don't remember that things are generally pretty normal. We're not in that cyclical of a market. I mean, we are. Like things go up and down. You have good years and bad, but I don't know that we've ever seen. The old timers that we talk to will talk about how bad it was in the early 80s whenever rates were 17%. So that's probably the last time that we saw a swing that was.
And people were still buying houses.
That's how they always finish it. Yeah, it's a basic human need. You need a house, and it's not even a need. It's like a want that you don't want to live in a house that's too small for you. You don't want to live in a house that's too big. The other part of that, go ahead. The other part of it is, you want to look at what's working, but then you also want to become more efficient. And the Pareto principle is that 80% of your good results are going to come from 20% of your actions. Well, that means you're wasting 80% of your time. So figure out what you're doing that isn't effective and get that time back. If you want to be hyper productive, do productive things, or, go hang with your kids, go for a walk, do something that doesn't feel like, work that actually isn't.
Is it a money-making activity? If we're talking about business, is this a money-making activity? Right. I hear from an agent perspective, sometimes agents are going to want to keep themselves busy. So they're going to go over to this house and pull a sign, and they're going to go check on this listing, and they're going to kind of then they're going to go by the bank, and like they're going to go do things. But are these really money-making activities, or are you just trying to fill the time because you don't know what to do? Don't fill the time. Like, what can you do to make money in that time? Go to lunch with someone from your sphere. Reach out to a past client,
hold an open house.
I mean, any of it, right? Like I tell the girls in my office, if y'all have time to sit around and talk, you have time to make calls, like what are the money making activities? What are we doing? And I think that's important. Again, guys, I think the worst is behind us. 25 is going to be better than this year. And I, for one, am very much looking forward to it.
I am too. I feel like we said this last year because that was the, and that's where experts can be wrong. But everybody predicted that the Fed was going to start lowering rates in March. That was the majority opinion, and it didn't happen. It got pushed back 6 to 9 months.
Thank you. We've got a question.
So earlier you hinted at or made the statement, we have less agents now. So I hear different numbers. What do you think our agent count in Austin is now?
So I used to track it.
Our high was 18,000.
It was higher than that.
Was it higher?
Yeah.
Okay. What was
it was in the 19s for sure. And it's a very, they don't make the numbers readily available. So what I would do is go to the ABOR member search and just click search and then write down how many were there. It hasn't gone down like we thought it was going to. What did you see whenever you searched last? I don't know if that's the case. I mean, you can go to abor.com and just go to member search and click search. It'll show you the count. It does go up and down. This probably wouldn't surprise you, but it's funny when I realized it. It goes down a month after dues are due. It's back up like a month later because they pay them. So you see a lot of fluctuation. This. I mean, I can't prove it, but I think everybody would probably agree with this. The number of agents who are working hard has gone down significantly for understandable reasons. It's hard to track because how many agents are driving Uber now? How many agents went and took another job but kept their license? Everybody gripes about dues. It's the cheapest thing in the world. $100 a month to have inventory. That you have an incredibly positive return if you sell one home. Like you just don't see people drop out that much. What about what it's been? Yeah. Thank you.
Other questions?
Going back to the beginning of the discussion, but you touched on downtown, touched a bit on the job market. I'm curious what you forecast for kind of our outskirt areas that were rapidly growing in 21, 22, like Taylor with Samsung and Tesla, Bastrop with Netflix. Are you seeing a major slowdown there? Do you anticipate that picking back up?
Those are really running numbers in those areas is really tough because there's so much new construction there, right? So home builders don't hit the MLS a whole lot, especially whenever times are good. So I think if you were to look at it, it'd look like there are more units out there. I don't know for a fact. I did look at Taylor because I was like, oh man, I bet the prices are still going up in Taylor. And I ran a quick search and it showed that they'd gone down a lot. Expert in that, and the numbers are really hard. The numbers are really hard to get to. Are you asking for your own business or to advise clients?
See it in the outskirts because Austin is still really expensive, right? One of my best friends lives in Taylor as a real estate agent in Taylor. We talk about it a lot. It's slowed down a lot, but Taylor is cheaper than Austin, and a lot of like as much as I love Austin and can't imagine anybody not wanting to live here, a lot of people don't. They'd rather be out Taylor specifically for the schools, for the land, the city, just kind of it's that small town feel. You go down to Main Street and it's like 3 blocks of downtown and everybody knows everybody and they've got this new beautiful park with a skate park down there and it's awesome. There's condo projects getting ready to go up close to downtown Taylor as well. So I think that specifically that, but the outlying areas, as things come back into Austin, prices aren't going down, so people are still going to need to live, I think, further out.
So do you have clients that need to sell now, or they're concerned about their purchase? I know as an agent, it's easy to carry guilt if you help somebody buy in a peak market, right? I mean, unless you're the agent that told them like this is going to be worth a ton more money next year. I mean, they were making a life decision. You're helping them with that. If you didn't have, but really, like that's why I lean on the script so heavily of, look, you have to be 100% sure you're going to be here, at least 3 years, and like 99% sure you're going to be there for 5, right? It doesn't make sense unless you're really sure you're going to be there for 5 and hopefully longer. And if you have that conversation, then you can say, guys, look, like obviously you moved out here for a reason. Why do you care about the price? I have a client that always wants to know what his house is worth because it kept going up in value. And I didn't ever say it to him, but I was like, do you want to sell it or what? Like, why does it matter? Whenever you're ready to sell, whenever you're starting to figure out what the home is worth in order to make a move, then sure, it matters a whole lot. But you don't want to be that flippant when you talk to them. You can just show them what's happened over the past 10 years. And the way the chart looks pretty much everywhere is a straight line up, down like that, and if they bought up here, you could run the math. It'll probably be 5 years. They'll be back to where they're in an okay spot.
I'll call her out. Renee Kessler, good friend of mine, agent, talks about a house she bought in Rob Roy in 2008. And do it, Rob Roy. And pretty immediately went down. Later, she was positive on it. And you saw a lot of that back then during the financial crisis. And I think that's the same thing now.
What is sort of, I guess, like tribal knowledge that people say a lot, which seems to ring true, is that the market recovers from the bottom up, inside out. So the lower you are in price, the better off you are. The closer you are to central, the better off you are. And you combine the two, you're in good shape. And I think that's, with the exception of like teardowns, because the infill builder market is just nobody's building right now. So if you have teardowns, you hopefully don't need to sell. You're hopefully not living there. But if you're in a starter home in like 4.5 or a starter home in like 5.7 or something like that, you're probably in pretty good shape. And as the prices go up, the harder it is to sell those. And as you go out, the harder it is to sell. Coming. Yeah. Stuff's fun. We'll send an email to everybody with some of the resources. We have like a stat sheet. Max has one. I'll send that. I'll send everybody a link to Mike's podcast. He's got a lot of good stuff. I really like his last one. It's not like I don't know. He just offers his insights into the industry and to agents in general. And I think it's good to listen to.
Also, What's Your Angle podcast is going to be coming out more frequently starting next year. So check that out.
Absolutely. Subscribe to the channel.
I think we do have a question, actually.
Sorry. Charts too.
Real estate related. Thank you, guys.
Thanks, guys.
Thank you.